Alright, you guys, so this is TLT today, and what you're looking at is you have this gap down, you had this move upwards midday, and then a sell-off at the end of the day. And so I'm not going to talk too much about this little micro cosm here, but more so the macro and what's happening and why it's really important to understand as far as your financial life, like what the underpinnings. You go to work every day, you do all these things. What is money and how to protect yourself? And so basically I put this up here for you. So there's a sovereign bond, which is basically a treasury bond, debt security issued by a national government to raise money for financing government programs, paying interest on current debt and other government spending. So essentially the US government issues a bond, and then you get a percentage back when that bond is basically, whether it's a 10-year, 20-year, or whatever, at the end of that period, you're guaranteed X amount percent return plus the premium you paid. Pretty basic stuff. And so I just want to show you a few things that are real important with what is going on essentially globally. And to give you some of that, I have to give you some idea of the what these things are so you can better understand. So like I was explaining, that what is over here, all these Bitcoin, the dollar, the yen, the British pound, the S&P, these are all like bricks on a sidewalk. And beneath the sidewalk there's a substrate, little pebbles usually, that keep it all flat and stable. That's kind of what a bond is, okay? And so in order to understand the story as well, you have to understand this little thing. You might have heard of Bretton Woods. And basically all that means is that the US dollar was used as the medium of exchange for international action. In other words, trade happens in US dollars. So you need to convert it out of yen into dollars, right? In order to then convert it back to pounds if you're doing business internationally between the UK and Japan, let's say, right? So that's why they say that the global currencies get pegged to the US dollar. So if you understand that much, then you can understand what's next. So that's just the little history part of it, so you kind of have some basics there. And so what we've seen, and what is very important about this, is that there's a liquidity crisis in the bond market. And I talked about this all the way back here in June, or around here in June. And so bonds need to be liquid. And like I said, the bonds are required by law to be held by institutions, by big banks, by the people that own the pensions, right? And so the bonds, there's only two kinds of high liquidity, high quality assets. One is bonds and the other is dollars, right? So you can see this is showing you that there is more of a supply of bonds than there are buyers, okay? And some of this is normal and that's okay, but what we're seeing this week, this is a weekly chart, is that something very significant has happened here. So these are two ideas, and like I was saying, for this kind of a move to happen, where you broke a historic support dating back to June of 2014, where you broke a historic support, something major in the global markets has happened, in the global bond market. And so these two ideas kind of pop out, and you can see that if you it's a little maybe complicated for this, but this is the US dollar versus the yen. And basically this is how much yen versus the dollar, right? Exchange rate. And so you can see that this is moving up, right? So that we have this government intervention on part of the Japanese government, which is causing this, right? And what that is the essentially the Japanese government, the yen rallies against the dollar as the Japanese authorities intervene to prop up a currency after hitting a 32-year low. The Japanese government selling U.S. treasuries to buy its own currency. So what you're seeing is the Japanese government is basically selling bonds, right? Selling bonds, creating more supply. So the TLT is coming down in order to buy its own currency to prop it up, okay? So you have not enough buyers and too many sellers. So like I said, this kind of move would require a country. And so you can see evidence of that if you look at what's happening with the yen, right? So they're selling U.S. treasuries in order to prop up their currency. They sell the treasury and then they buy yen, right? So the other thing is, another story from recently is, it's called a swap line. And so because everything's pegged to the dollar, right? So got to remember this part, everything's pegged to the dollar. So we have a central bank, Fed Powell, etc. And interesting story here is that our bank, the Fed, created, it's called a swap line, and it's basically a short duration loan, about a week, right? So in this case it was about a week, and what they said is we'll give you $9 billion US dollars, and to the Swiss bank they gave us the equivalent Swiss francs. No big deal. It's just an easy-going exchange, it seems. But the question is why this bank needs the US dollars, right? And so what I was pointing out, and what is happening here, is the two stories that I had talked about. You can see why this might be happening. Okay, because you have the Japanese government selling its own treasuries to buy, U.S. treasuries to buy its own currency. And at the same time, this is a little bit more under the radar. This is pretty overt, but in order to understand this, you got to think about it a little bit deeper. So let's say that the Credit Suisse, which is this big institutional bank, okay? So the Swiss National Bank needs to borrow money to bail out what would be our equivalent of JP Morgan, right? So why could that be happening? If you look over here, let's go to this, okay? So this is what I've been talking about with the pensions and the derivatives. So let's say that, and this is just an example, but I do think this probably happened, actually. This is why I think this happened. Because this bank, this Credit Suisse bank, Suisse, they call it Suisse, Credit Suisse, they had exposure to the British pound, and they probably had exposure to these pension funds. And as the system began to collapse, they used leverage and margin. So much of this is caused by derivatives, leverage, and margin. Essentially spending money you don't have, or leveraging money you don't have on an idea that you have. And if you've traded like on BitGet or something like that, you have some idea what that can look like. So what would happen is, as these pensions began to collapse, this bank needed a bailout. Essentially, they had exposure and potential collapse of this bank. And this goes back to this idea of, there's a list of these banks that are I think called DSIBs, and those are the banks that, if they're world banks, not central banks, but they're like JP Morgan and Wells Fargo, but they're all over the world, Bank of China. And those banks, if they fail, just that bank alone pose a systemic risk to the whole system. Okay, so what happened was this bank was leveraged up in these pensions, and they might have had a margin call. As things started to collapse, therefore, the Swiss National Bank needs to step in, bail them out, but the Swiss National Bank doesn't have the dollars on hand, right? They don't have dollars on hand to bail out this bank. So what do? They go to the U.S. central bank, where everything is pegged to, right? They borrow the $9 billion, they bail them out, and they avoid the margin call, right? And so that's why you see, when you see these big moves in TLT in the US bond market, it's a new monetary system. So in the past, most people are used to, I've said this a lot, everyone who ever traded Bitcoin in a bull market. Bitcoin was born in a bull market. And the underlying monetary system, based on what I'm showing you, if you look at these charts, the yen, the British pound, you see how the actual monetary system's changing, right? So that's a core concept to understand, is that this is showing you that the money you spend in the actual system beyond inflation, a lot of people will look at this and go, well, it's all about inflation. This is a little bit more complicated than just simple inflation in a lot of ways. But the part of this that's important beyond all this information is that the idea here is that the U.S. Treasury, that's why I included this. So we're talking about the U.S. Treasury. It's one thing to see Italian bonds do this, but if the U.S. Treasury, if there's no buyers because everything is pegged to it, if this begins to fail, what do you think happens to these other parts of the system? And so there's going to have to be some kind of intervention and some kind of tricks that come out of the Fed, because they might have to buy back or create some way of keeping this bond liquid, because if it isn't, liquidity, like the velocity of money, the way money is based on the amount of times it exchanged. If it's just sitting stagnant, it doesn't really do not much. So they need liquidity, they need buyers and sellers, and what we're seeing here is a lack of liquidity in the bond market. And so they're going to have to do something to correct that. And that's what this is. This is the Japanese government trying to step in and do something, or the Swiss trying to step in and do something, or with the pound, them trying to step in and do something. But the problem is that when you look at this, so let's look at this real quick. So the issue is that in the past, whenever you had one of these potential collapses, like the 2020, everybody's aware of that, 2008, all these are different collapses. You've always had the quantitative easing, which is the central bank buying basically these bonds, basically stepping in and saying, we'll take on, and they call it quantitative easing, right? So they do a bond buying program, right? And so when we had the collapse here, what happened was you have this bond buying program, and the market likes the cheap money, right? But the issue here is that these monetary systems are collapsing, okay? But if you create if you quantitatively ease during this inflation, this is the market responding to inflation, and you do a pivot early like the market wants because they're a bunch of degenerates, then you're going to get a move upwards. And if the pivot is too early and too strong, and I did a video about this before, this is how you create hyperinflation, okay? And so if they pivot in order to save this bond market, in order to create liquidity, okay, then they risk hyperinflation, okay, because that puts more money in the system at a point where we already have too much, right? So that's one way to understand it, is that that would create hyperinflation. If they don't create the easing, then there could be a lack of liquidity in the bond market, and we don't really know where that goes. But what it would do for sure is create deflation, which is the deflation of assets, all forms of assets. And some people may think that's a good idea, but what that looks like on the market is probably about 260 on the S&P would be my right around here. And this is where the average person gets crushed soon. So it's an issue of when, right? So if it happens now, the average person over the next 2 to 3 years is going to get crushed. If it happens later, then they create the quantitative easing. It creates a far worse problem later on, but these guys are kind of famous for doing that. So if they create the hyperinflation, and then you get into the conspiracy realm, because that's how you get into digital currency, right? Because once this US dollar system is inflated, hyperinflated away, then you can step in with something like a central bank digital currency. And then this thing called Bitcoin would make a lot more sense, because in order to create a system with one world currency, you would need to have a big long trial run, something dating back to like 2008 or 9. You would need to create and test a whole marketplace with all these different creators and these inventions of digital currency, and you need to test that. You can't just pop up one day with it. You have to start the people to understand and to adapt, like people talk about adoption of a digital currency. Well, this is this thing here that was invented by somebody who still remains anonymous. This thing here called Bitcoin, if this other idea plays out, this hyperinflation, and it's inflated away, and this is a period of a decade. This isn't short term. This is 6 years, 7 years it would take to do something like this. But then it would make a lot more sense. What is this thing? That's just one of the ideas I have as to like what really is this? Why is this person anonymous? Someone who created something which has changed the entire financial world remains anonymous. Kind of suspicious to me, man. But anyway, that's a little bit of why today's important, and in order to hedge against that, there's certain things that you can do. In the meantime, as this all collapses, and these people wonder, like, where was my opportunity when this all happened? And 1% of the world's population or less owns gold and silver, and there'll be a time for that. But even less, 1/10 of 1/100th of 1% knows what KuCoin is. And then even less of those people know what a 3x short, this very small marketplace where you can leverage without fear of liquidation. And as this all falls apart, this marketplace here is going to be a good place to hedge against this inflation. And so there'll be other plays that are available, like the natural gas play, down on that quite a bit at this point. I'm probably down 10% on that because I got stuck with this one here this week. But you know, I'm not worried about that. Ultimately, there'll be gold, there'll be silver, but you gotta wait on those. So anyway, hope it helps.